Hi, I'm Semil Shah, and I'm here at August Capital in Menlo Park with general partner David Hornik. David, great to see you.
Thanks for coming.
So I thought we'd have a wide-ranging discussion. You're a pretty outspoken guy and have been in venture for a while, and I think it would be great to hear just your perspectives, historically and what's happening now and what's going on, in the Valley, on Sand Hill Road, and a bunch of other topips.
Sounds
So
great.
the first question is just, let's dial back 5 years, 2008, let's say pre sort of Lehman Brothers. What in your mind is like the starkest difference between what's going on in venture capital, Sand Hill Road, 2008 versus 2013?
Sandhill doesn't change a ton. We're trapped in time. If this could be like a 1960s strip mall, it would be, and be full of offices of people who are basically trying to do the same job that we've done for, I guess it's not 1960s, since for the last 30 years.
Yeah.
But on the other hand, in the late 90s, the venture business got very big. Everything was working. So if you started a business in 97 and you hadn't taken it public by 98, then something was wrong with you. Then you'd chosen too small a vertical. You were going with like SiameseCats.com and you should have gone cats.com. But I mean, everything worked. And so there was a ton of money coming into Silicon Valley. There was a ton of money coming into venture. And what had been quite a small industry, dozens of firms became hundreds and then thousands of firms.
Wow.
And it was sort of an astonishing growth. And then by 2000, the market got very tough. A bunch of the things that people thought were going to work didn't. A bunch of the firms that were counting on everything going public suddenly were under a lot of pressure to try and deliver returns. And so from, say, 2000 to 2008, there was a lot of hunkering down and trying to figure out, how am I going to make this work? How am I going to actually invest in companies that turn into value and return, economics to my investors? And so the 10 years kind of from 2000 to 2010, as it's been widely reported, if you invested $1 in the venture industry, you got less than $1 back. So not a great investment vehicle. But the reality is that the venture business isn't like this, this gargantuan uniform thing. It turns out that it's a bunch of funds that are made up of individuals, and those individuals and those firms are varying degrees of good at investing in emerging startups. And so the very best funds have had no problem continuing to raise capital over the last 5 years. So since the market collapsed, a lot of investors rethought, what are we going to do? Are we going to still invest in venture capital? Can we afford to still invest in venture capital? And many of those traditional players have said, we're out. And the byproduct is that new funds that are being raised have a much higher bar. And so the top 20 firms are able to go out and raise capital, but it used to be the top 100 that had no problem raising capital, and that's just not the case anymore. So that's a big change, it turns out. But these funds last a long time. It's 10 years of a fund. So there are lots of people who raised funds in 2002, 2003 that are still busy trying to, deliver returns. And once they do that, then they'll go raise the next fund. But they're on the decline, while there are a very small number of funds that have continued to invest on a standard path.
Great.